If you think this move was random, watch this carefully. Before price dropped, the market first broke structure, signaling a clear shift in institutional intent. Then, price returned into a premium order block, not to buy, but to distribute sell orders. Notice how price created inducement in this zone. That was deliberate. Retail traders were invited into long positions, believing continuation was coming. But the real objective was never higher prices. The objective was sell-side liquidity resting below these equal lows. Once enough liquidity was built, the algorithm executed with precision, sweeping stops and delivering the final expansion. In this video, I'll break down every step of this move, from structure break to order block to inducement, and finally, perfect execution. So if you want to understand how institutions really move price, don't blink. This chart will change the way you trade.
Let's focus on the break of structure on this chart. Up to this point, price was respecting a bullish market structure, continuously forming higher highs and higher lows. That bullish narrative ended right here. When price closed decisively below the previous higher low, this was not a normal pullback. This was a break of structure. This tells us that buyers lost control and institutional order flow shifted bearish. Break of structure is not an entry signal. It is confirmation of intent. At this moment, smart money stopped pushing price higher and started preparing for sell-side objectives. That is why, after the structure break, price did not continue falling aggressively. Instead, it retraced back into premium, allowing institutions to mitigate sell orders inside the order block. This break of structure gave us one clear message. The market was no longer looking for higher highs. It was now seeking liquidity below. Every move that followed, the order block reaction, inducement, and final sell-off, was a consequence of this single structural shift. If you understand this break, you understand the entire chart. Now let's break down the order block on this chart. After the break of structure, price did not continue straight down. Instead, it retraced back into this premium zone. This area marks a bearish order block, the last bullish candle before strong bearish displacement. This candle is important because it represents the zone where institutions placed large sell orders. Due to the size of those orders, price could not move instantly, leaving unfilled positions behind. That is why price later returned to this level, not to reverse, but to mitigate and rebalance those sell orders. Notice how price reacted inside the order block. No strong bullish expansion, weak upside follow-through, clear hesitation. This tells us supply was dominant in this zone. In smart money concepts, order blocks are areas of execution, not support or resistance. When price trades into a bearish order block after a structure break, the probability favors continuation to the downside, not reversal. From this order block, smart money prepared price for the final move, the attack on sell-side liquidity. Understand the order block, and you understand where institutions sell. Now let's understand inducement on this chart. After the break of structure, price returned into the bearish order block. Instead of dropping immediately, the market created a temporary bullish move, and this is where inducement occurs. Price formed small higher highs and higher lows, giving the illusion of strength. This move was not real demand, it was engineered. The purpose of inducement is simple: to invite retail traders into long positions and to trigger early sell stops from impatient sellers. When traders see this minor bullish structure, they believe the market is reversing. But smart money sees liquidity being built. Every long entry here becomes fuel for the next sell-off. Institutions use this phase to fill remaining sell orders at better prices, deep inside premium. Once inducement is complete and enough liquidity is collected, price no longer needs to pretend. That's when the algorithm executes the real move, a strong bearish expansion towards sell-side liquidity. Inducement is not noise. It is intentional manipulation before execution. If you can identify inducement, you stop chasing entries and start trading with institutions. Now, let's focus on sell-side liquidity on this chart. Sell-side liquidity exists below market structure, where retail traders place stop losses on buy positions and sell stop orders. On this chart, that liquidity is clearly visible below these equal lows. These equal lows are not random. They are magnets for price. After the break of structure, smart money's objective was no longer higher prices. The objective shifted to accessing this sell-side liquidity. That is why price first moved into premium, formed an order block, and created inducement. All of that behavior was preparation, not execution. Once enough liquidity was built above the market, the algorithm released price with strong bearish momentum. The move down was not emotional selling, it was efficient execution. When price swept below these equal lows, stop losses were triggered, orders were filled, and smart money exited positions without slippage. This is why price moves fast into liquidity and slows down afterward. Sell-side liquidity is not a target chosen by traders, it is a requirement for institutional execution. Understand where sell-side liquidity sits, and you'll stop asking why price moves. You'll know where it must go. Now, let's break down the sell trade execution on this chart. The execution does not start at the drop. It starts after the break of structure, which confirms bearish intent. Once structure is broken, price retraces into premium, aligning with the bearish order block. This is where smart money looks for short positions, not at the lows. Inside the order block, price forms inducement, weak bullish candles and minor higher highs. This confirms that liquidity is being built, not that demand is entering. The sell entry is taken after inducement is complete, at the refined order block level, with price showing rejection and lack of bullish displacement. The stop loss is placed above the order block high, where the bearish idea becomes invalid. The target is sell-side liquidity resting below the equal lows. This gives a clean, high probability, high risk-to-reward trade. The final bearish expansion is not chased, it is expected. This is how professionals execute sells. Structure first, location second, liquidity last. Trade execution is not prediction. It is alignment with smart money.